macro factors influencing financial markets this year, leading to what can only be described as challenging conditions for investors, has been the surge in inflation and the subsequent aggressive policy pivot by central banks. In fact, central banks are turning even more aggressive in their battle to get inflation down, with the US Federal Reserve delivering a 75 basis point hike last month, which is their largest increase since 1994. A similar size increase is expected to be delivered this month. It is this increasingly aggressive response by central banks, together with a string of softer economic data in some major economies, that is now seeing market concerns begin to morph away from inflation and more towards the outlook for economic growth. These growth concerns have seen longer-term bond yields fall from their highs, commodity prices weaken, and within equity markets, defensive sectors outperform cyclical ones. Some parts of the world are facing into some clear growth risks right now. In Europe, you have the obvious challenges created by the Russian-Ukraine conflict. China continues to face challenges from its ongoing elimination approach to containing COVID. Locally, the sharply weaker housing market is a clear source of growth risk. But more generally, it is the unbroken resolve of central banks to bring inflation under control that is the main source of growth concern. It has become quite clear that to get on top of inflation, central banks appear willing to accept an even larger growth and employment trade-off. Now, I believe there are plausible ways a recession, at least in the US, can be avoided. However, I acknowledge that the path for this to occur is rapidly narrowing. What I would add though is, while it's always dangerous to make sweeping generalizations given recessions come in all shapes and sizes, what typically makes them worse is when they coincide with a build-up of large economic and financial imbalances, like strained balance sheets or credit misallocation, for example. To us, those imbalances are not so evident today, suggesting that if a recession was to occur, it is likely to be relatively mild and shallow. In fact, and quite importantly, some of our research partners are arguing that such an outcome is now already priced into some key markets. Whereas equity markets have struggled this year because of the impact of inflation and central bank actions have on market valuations, growth concerns shift the focus to the sustainability of corporate earnings. Despite a constant stream of downgrades to economists' economic growth forecasts this year, analyst forecasts for earnings have steadily increased as firms have maintained and grown profit margins on the back of some newfound pricing power. Now, whether or not recession occurs, heading into a softer economic growth backdrop, it's very unlikely that this strong margin picture will be maintained. But how far margins and hence or earnings fall from here is open to plenty of debate and ultimately will hinge on the depth and longevity of any economic downturn. Naturally, the deeper the economic correction, the bigger the hit to corporate profits. To be fair, we believe markets have already preempted these profit downgrades to some degree. Nevertheless, all eyes will be on the Q2 reporting seasons about to get underway in the US and Europe to assess how companies are continuing to navigate this challenging operating environment. From a model tactical asset allocation perspective, we have recently made some shifts in a defensive direction. Given where bond yields have risen to and what is priced in by way of central bank tightening, increasing concerns towards the outlook for growth create what we believe is an interesting risk-reward setup for fixed interest markets, especially domestic fixed interest. And we have tactically increased our exposures to those fixed income asset classes recently. For growth assets, we now have a modest tactical preference for the relatively defensive New Zealand equity market over more cyclical Australian and global equity markets. And more specifically within equities, while we do believe markets have already preempted earnings downgrades to some degree, given growth risks, we retain a preference for companies and sectors that offer a greater degree of earnings and margin stability at the present. Perhaps most importantly, and it is probably the hardest skill to implement in practice, but at times of heightened market turbulence and tricky market conditions, the key is to not lose sight of your long-term investment goals and objectives, and to avoid, as best as you can, making overly emotional investment decisions. They typically don't pay off in the long run. I'll leave it there, but as always, please reach out to your JBWere advisor if you have any questions. Thank you.